Welcome to Securities' first quarter roundup for 2026. Last Feb 28, US and Israel launched joint strikes on Iran, marking a significant escalation in geopolitical tensions and targeting key military and strategic infrastructure. This triggered an immediate risk-off reaction for global equities as oil prices skyrocketed as political uncertainties intensified. There was a brief relief at the start of April, however, given US and Iran's two-week ceasefire, even as the global investing community continues to assess the conflict's broader economic implications. To get a general perspective, let us examine views why the conflict started. The highlight appears to be centered on natural resources control. Energy remains key source of global power, and whoever influences supply can shape inflation, growth, and geopolitical leverage. Iran is central to this, holding some of the world's largest mineral reserves. At the same time, the nuclear dimension raises the stakes, bringing Iran closer to weapons-grade capability, widely perceived to shift the balance of power. Looking ahead, the focus is expanding beyond oil toward rare earths and critical minerals essential for defense production, energy transition, information technology components, petrochemicals, and even fertilizer control. The impact is largely felt on oil, with futures starting the year at $57 per barrel and spiked thereafter since the conflict began in February, breaching to as high as $120 per barrel. On a geographic scale, the Middle East is part of a wider geopolitical force played by US, Russia, and China. And the political objective appears clear: amass as much as resource control. This year, the United States took over Venezuela following the capture of Nicolas Maduro, a move widely seen to secure oil resources. The launch of missiles alongside Israel against Iran was the next step of the conquest. This was compounded at the logistics front, with the Middle East zone a critical subject for proxy wars between US and Russia. Iran sits atop the Strait of Hormuz, the waterway in which 20% of the world's oil and LNG gas trade passes through. This makes it a significant leverage for Iran, as closing it would constrain the world of valuable oil supply. With Iran's closure of the strait, the number of vessels flying through this choke point has gone down by 35 times, hence tightening available supply. To date, Iran has used this waterway as leverage, demanding formal recognition of its authority for the strait through its proposed collection of passage fees. As commodity traders scramble to find alternative routes, a key geographic option was the Bab al-Mandab Strait in the Red Sea, parallel to the Persian Gulf and located between Yemen and Djibouti. Back in 2024, it is estimated that 4.1 million barrels a day of petroleum products passes through this strait. This option is starting to falter overall because based in Yemen is the Iran-funded Houthi camp, which began to engage in the conflict. In terms of supply and demand, Asian countries bear the heaviest impact. China is the world's biggest importer of crude, bringing in 5.24 million barrels daily. The US follows next, along with India, South Korea, and Japan. On the supply side, Saudi Arabia leads, being part of OPEC+, followed by Russia, US, Canada, Iraq, and UAE. Meanwhile, capital movements in global equities was compressed in the conflict. Prior to Feb 28, funds favored key markets in Asia led by South Korea, up 48% year-to-date, and Taiwan, up 22%. With a political stalemate between US and Iran given both nations' divergent terms, capital in global equities turned defensive as investors opted to cash out. South Korea's year-to-date gains have been tempered, while the Philippines turned negative from about positive 9.2% before the conflict started. Immediately after the shock, investors went to risk-off mode. This led to funds shifting into safety, primed by currencies, gold, and oil. Preference towards liquidity has become a dominant theme as investors held onto cash, money markets, and short-term treasuries.
The conflict continues to exact its toll on respective economies. It is estimated that the US has spent approximately $44 billion since the conflict began. Iran appears to succeed in the deployment of Shahed drones that cost between $20,000 to $50,000 against Tomahawk missiles deployed by the US, which costs $3.5 million each. From air-to-water military force deployment, political analysts fret a protracted conflict would be realized should the US start with ground-based invasion. Iran's deep-rooted political ideology is a force to contend with, given its apparent lead in air-based arsenal. Another headwind on President Trump's military campaign is his deteriorating popularity back home. Based on March 2026 poll by the Pew Research Center, 61% of Americans disapprove his decision to launch airstrikes on Iran. This raised the bar against the Republicans, who are facing heavy odds ahead of the US midterm election this November. Back at home, Philippine Equities saw similar risk-off pattern with the PSEI's drop. 90% dependence on imported oil plus the peso's weakness added pressure and presently being cushioned with the declaration of national energy emergency by the government. The question in most investors' mind is, are we back to pandemic levels? Certainly not, because valuations tell a different story. In 2020, business was on a halt, pushing market PEs to around 29 times. Today, corporate earnings have more than doubled, with market PEs trading 9 times. So while risk-off sentiment feels similar, the objective fact is still upheld, that fundamentals are significantly stronger. This suggests the recent price movements are driven by sentiment and not a crisis-level stress. Tracing October 1970s oil embargo that targeted countries that supported Israel in the Yom Kippur War, the scenario led to massive economic disruption marked by fuel shortages and 350% increase in gas prices. The lifting came in March 1974 that triggered changes where increased oil output from non-Arab nations was allowed. So while the intense military war aspect lasted only for 19 days in 1973, the long-term consequences were felt 7 to 9 years after. Similarly, gold moved 2 years early ahead of the oil crisis in the 1970s, with the bull run starting in 1971 and ending 9 years later in 1980, versus oil starting its bull run in 1973. Compare that to the present time where gold's bull run started in 2024, and 2 years later, which is 2026, the oil crisis started. While there are no identical events in history, the Middle East conflict we have today has run for more than a month already, yet the local economy remains supported by domestic consumer spending and remittances that place the country in a better position to absorb oil shocks. Unloading is common for those who worry about the present. Brave pickers at this juncture, however, support the concept of the future, lifting commodity prices. Estimates show similar pattern may be seen once the fog of complacency lifts.
On the initial quarter, investors rotated out of rate-sensitive plays towards sectors that benefit from stronger pricing and external demand. Interest rate-sensitive sectors underperformed, with financials and property declining due to margin pressure, weaker lending due to elevated borrowing costs. Meanwhile, services defied the trend, while mining and oil benefited from higher global commodity prices. Among index constituents, 17 declined while 12 gained. First quarter's lead gainers were ICT, JGS, and Monde, driven largely by company-specific catalysts. ICT's strength came from resilient global port operations, JGS from its strategic exit from Petrochem, Monde on narrowing losses from meat alternatives. Meanwhile, Ali, Converge, and RCR weakened. Across all shares, top gainers were DHI, Web, and SRTC. DHI's story was on its possible foray into mining, REV on its expansion into higher value digital gaming services. PXP was up on renewed hopes for offshore gas drilling prospects. On the downside, Ferro, T, and Prim lagged. On net foreign flows, January and February had positive flows, but was more than offset by a sharp reversal in March. ICT, AC, and Apex benefited from net foreign buying, while net sellers were dominant in SN, video, and AL.
Moving to economic outlook, from our end December GDP growth outlook of 5.1% to 5.5%, we have tempered this to 3.5% to 3.8% for 2026, driven mainly by inflationary pressures from higher fuel prices, transport costs, water and electricity charges. Investment buildup is also seen to slow as companies recalibrate implementation of expansion initiatives. Assuming firmer agreements are adhered between parties in the Middle East conflict, 2027 GDP is seen at 4.6% to 5.2%. For 2026, our revised inflation estimate is 3.5% to 4.5%, from our end December outlook of 2.4% to 3%. This assumes current fuel pump prices plus adjustments in water and electricity rates that include Meralco's fifth regulatory rate rebasing and recovery of prior year's losses from San Miguel and ASEM. For index outlook, drivers for best case scenario are cheap valuations, possible de-escalation of US-Iran rift, and continuity of policy reform momentum. Should a protracted conflict prevail and sentiment contends with higher for longer rate environment, the index could revisit 5,800.
As presented in December, our portfolio strategy is maintained, anchored on defensives, real assets, and dark horses. Banks and consumer baskets remain core to defensive positioning, with most providing good trading angles. Metrobank and BPI lead in upside potential, supported by strong balance sheets and digital initiatives. Under consumer retail, CNPF has been added. Jollibee's stories remain on its US listing spin-off, while Pure Gold remains an essential consumption play. Still within defensives, ICT is poised to benefit from resilient global trade flows. For power, ASEN offers good upside from its renewable energy pipeline. Meralco and AP are seen to benefit from improved generation contracting and capacity expansion. Meanwhile, SGP is a solid bet on transmission, underpinned by National Grid Corporation's large capex pipeline. Among REITs, the highlight is on asset infusions that are seen to be yield accretive. Water is not to be left out through Maynilad and Manila Water, with extra support from the tariff resets. Under real assets, the focus would still be on property and mining. The steady stream from commercial and industrial lease and horizontal housing enhances NAV valuations, where most large caps with solid land banking drives are still trading at a discount. On mining, the race for precious mineral resources remain the underlying theme. Leaders such as Lepanto, Apex, and OGP offer compelling investment angles set to benefit from bullish metal prices. And finally, our dark horses. We've refreshed this basket, removing MWide and SEB and introducing conglomerates, where we see deep value starting to emerge. Names like AC and GTCap offer discount windows, especially with improving contributions from emerging businesses. Under technology, IMI has a turnaround angle. Ongoing restructuring and margin recovery efforts position it well for a cyclical rebound, especially as global electronics demand gradually normalizes. For telcos, we've added Tel alongside Converge. Tel offers a more defensive angle, backed by Maya's improving profitability and potential value seen to be unlocked from its data center assets. Meanwhile, Converge remains a structural growth play, leveraging the AI-driven surge in the data demand. Overall, these names may not be a consensus picks today, but that's precisely where the opportunity lies as catalysts began to play out and valuations re-rate.
For our revised top picks, Maynilad, Meralco, TEL, OGP, CNPF, and Metrobank appear poised for solid results this year. These reflect defensive bets and provide sustainable dividend yield amidst a more challenging environment. Thank you and see you in our next sequel update.